Hello, in this lecture we're going to talk about partnerships and we're going to talk about the selling of a partnership interest. We will be able to describe the process of selling a partnership interest, create the journal entry to record the sale of a partnership interest, define the effect of journal entry to sell a partnership interest on the trial balance accounts, and explain the effect on the capital accounts of selling a partnership interest. So we're going to do this by looking at a problem. We're going to look through the problem, post the transaction, see what happens to the capital accounts in terms of both a trial balance as well as a format of just a worksheet type of format. This is going to be our simplified accounts that we will be looking at. Only cash that we're going to have, only asset that we will have will be cash. Only liability, accounts payable. And then we will have our capital accounts. This is where we will be focusing on. And then we have the income statement down here. Note that nothing is in the income statement. The income statement has been closed out. You can think of this as a post-closing trial balance or just basically the balance sheet accounts being represented here. We also have the accounting equation, assets equal liabilities and owner's equity. Also note that we have the debits represented with non-bracketed or positive numbers and credits represented with bracketed or negative numbers. This gives us an easy balancing process in that we see this 0 down here represents the fact that the assets minus the liabilities equals 0. Therefore, the assets equal the liabilities, and we can shorten our debits and credit columns and have a quick worksheet to see what the transactions will do to our trial balance accounts in this way. Clearly, net income is 0 at this point because the revenue and expense accounts have been closed out to the capital account balances. So what we have are the three partners, M, B, and L, represented here, and these capital accounts are going to share their profit and loss at a 3-to-5 ratio. We're going to say that B will be selling their capital account interest to N. So here's B, here's capital account interest, here's N. That's who we're going to sell. B is going to sell their capital account interest to after the transaction was approved by the other two partners for cash of $120,000. Now, one of the tricky things when we think about selling a partnership interest is that who are the two parties in the agreement is the first question we need to ask. In this case, the partnership is actually not in the transaction. The transaction is between B and the new partner, N, meaning that there is $120,000 exchanging hands here, going from one account to another, but it's not going to the partnership account. Therefore, the partnership is getting nothing. So when we ask our question in terms of is cash affected in terms of the partnership, in this case, no, it's not affected. The agreement, the deal is between B and N. B says, hey, you know what? I have a partnership interest. It has a book value of $124,200. What does that mean? Well, the assets amount to $550 minus the liabilities of $10 mean that we have $540 broken out book value of the company, and B owns or is owed $124,200. That's the value of the company that is owned, or the partnership that is owned by B at this time. B says to N, hey, I'll sell you this partnership interest worth a book value of $124,200 for you giving me cash of $120,000. Partnership not going to receive anything. However, the other two partners do have to agree to this, that the other two partners are not forced to take on N as a new partner just because B wants to sell the partnership interest. The other two partners do have to agree to the terms, and if they do agree, then B and N can have this transaction and make this transaction happen. So first, let's talk about what this ratio means, the 3-to-5. So when we think about a partnership interest, if there's two partners, the most common partnership interest would be, what, a 50-50 or 60-40, something like that. We will often represent the partnership interest in a ratio format like a 3-to-5 for various reasons. One, it's a little bit shorter, and two, if the ratio is not even, then it's more specific to have a ratio rather than representing it as percentages. So if we were to look at this, then M's capital count is going to be 30%, calculated as 3 divided by 3 plus 2 plus 5 is 10. So 3 over 10. So that's how you calculate that. 0.3, move the decimal place 2 places over, 30%. Then we have, of course, B. So if we take a look at B, we do the same thing. B is the 2. So we're going to take the 2 divided by 3 plus 2 plus 5, or 10. And that gives us the 0.2, move the decimal 2 places over, 20%, 20%. And yes, we'll do this one more time for L. L has a partnership interest of 5. So we're going to take the 5 out of the 3 plus 2 plus 5, 10. And that gives us the 0.5 or 50%. If we add up the 30, the 20, the 50, we add up to, of course, the 100%. So whenever you see the ratios breaking out, if you see any ratio broken out like this, 3:2:5, you add them up, 3 plus 2 plus 5 is 10, 3 over 10, 2 over 10, 5 over 10, and that will give you your ratio breakout. Now, if we look at the capital accounts, then we have 151.2, 124.2, 264.6 adds up to 510. Note that those are just the same capital account balances that would be represented on the trial balance. So here they are on the trial balance from M, B, and L. You could have problems that would represent this in terms of a table, could have problems representing it in terms of a trial balance. I really like seeing it in terms of trial balance because as accountants and bookkeepers, we're often going to be using trial balances and it could help to see it in that format, but it's also very helpful to see it in terms of a table. Note that the assets minus the liabilities equals these capital account balances. Also note that these capital account balances are not necessarily in proportion of 30, 20, 50 of the 540. A lot of people will think that that should be the case. Not the case. Normally, the 30, 20, 50 represents how we allocate net income. Doesn't have anything to do with the actual ratio of account balances in the capital accounts between the partnerships. Reason being is because these accounts only represent to income and loss allocations generally, and depending on the terms of the partnership agreement. And that means that we could have invested different amounts and partners could have drawn out different amounts. So these capital accounts basically represent the amount that a partner could theoretically draw out of the company. All right, so then if we go on here, we're going to look at our journal entry to record this transaction. So what is happening is that B is going to leave the partnership. So if we think through this, we're going to think through, well, is cash affected? In this case, we're saying no, cash isn't affected. It's not affected even though cash did exchange hands. However, the cash didn't go to or from the partnership. The cash went from N, the new partner, to B personally. Not B as part of the partnership, but B's pocket. Therefore, no cash went to the partnership. What did happen is B's giving up their capital account. So B's on the books, B's gone, B's leaving town, he's not going to be here anymore. We need to say, hey, B's on the books at 124.2, B's gone now, their partnership interest needs to be 0. Therefore, the capital account balance has a credit balance. We need to make it go down. We're going to do the opposite thing to it, which in this case would be a debit. So we know we're going to debit this capital account, which will bring it down to 0. Then we have to credit something. What are we going to credit? We're crediting the new person coming onto the books, the new person N. So N will be credited for the 124.2. N is going to be on the books 0 up to by 124.2 to 124.2. So it's a pretty straightforward journal entry. The question though that people are going to have is they're going to say, well, wait a second, what about the 120 up here? If N paid 120, shouldn't their capital account go up by 120? Why is it going up by 124.2? And the reason is because, remember, the agreement was between N and B. So N said, hey, I'm going to give you my share of the partnership interest. The partnership, my share of the 550 minus the 10 is 124.2, and I will sell that to you, N, for $120,000. So you might be asking, well, why would B sell their partnership interest, which has a book value of the 510 assets minus the 10 of 124.2, and only receive 120,000? And there could be multiple reasons for that. Maybe the value of the assets are not fair market value as is negotiated between the two partners. Maybe B needs to leave quickly and needs to make the transaction happen. Very rarely will those two things match. So just be aware that if the sale is between an existing partner and a new partner, then we need to take the current partner off the books at whatever they're on the books for, and then put the new partner on the books for whatever the old partner was on the books for. No cash is affected in the partnership. because the cash went into the pocket of the partner, not the bank account of the partnership. So if we were to look at this in terms of a slightly different way we can look at it, what if B sells the capital interest to the partnership for cash? So now B's saying, hey, I'm going to take off, I need to leave, and I want to sell my partnership interest to the partnership. So now the other two partners, M and B, are going to basically buy out, M and L are basically going to buy out B in this case. So that's going to be the arrangement of the agreement. B is going to sell the capital account to the partners for cash of $200,000. So is cash going to be affected? Yeah. So we're going to think about this. First, I want to think about the part of the journal entry that we can do. Then we'll run into a problem, and then we'll do some calculations to adjust for that problem. So first we're going to say, is cash affected? And we're going to say, yeah, cash is going to go down because the partnership is paying B for B's interest. So the partnership is saying, hey, B, we're going to give you $200,000 for your capital account interest. Therefore, we're going to take cash down. Cash is a debit balance. We're going to do the opposite thing to it, which is a credit by the amount paid. And then we know that B needs to be off the books. B's on the books for 124.2. B is no longer with us. Therefore, B should not have any amount in their capital accounts. Therefore, that's a credit. We need to make it go down by doing the opposite thing to it, which would be a debit of the 124.2. So now the partnership paid $200. B is going to be off the books at 124.2. We have a difference here. So we have a difference, and that's going to be a debit. That debit's going to have to be divided in some way between M and L. Now you might be saying, well, once again, if B has a 124.2 interest in the partnership, why is it that the partners would pay $200,000 to pay off the capital account balance? And again, there could be multiple reasons. It could be that there's some kind of goodwill in the partnership that's not being reported in the book, some type of intangible assets. It could be that they really want to let B go, and they're willing to pay more in order to do that. So there could be multiple reasons for that, but once again, that's an agreement between the partnership in this case and B. So those things will very rarely match. Now we need to figure out how to allocate that difference, how to allocate that plug. So we have our MB and L, which is a 30-20-50 ratio that we discussed before between the 3-2-5, 30%, 20%, 50%. Here's the same capital account. So here's the capital accounts here. Here's the capital accounts represented in terms of a table. Book value of the company, 540. That's equivalent to the assets, cash, less the liabilities, representing accounts payable in this case. And then the new income and loss ratio. So now we have to say, well, B's gone. Therefore, we can't allocate between M and L between a 30-50 because it needs to add up to 100 or 1. So we need to come up with a new ratio. So if we look at this, if we had a 3-2-5 ratio and now the 2 is gone, we can think of it as a 3-5 ratio. So if we think about our new ratio, then we could think that we have a 3 out of a 3 plus 5 is 8 divided by 8. So our new ratio would be 0.375 or 37.5% for M. And then if we think about L had 5 over the 3 plus 5 or 8. So we can say that we have a 0.625 or a 62.5. So our new ratio that we're going to allocate this amount by, this difference by, will be the 37.5 and the 20 and the 62.5. So now we're going to allocate this difference. So that difference being the 200,000 cash received minus the capital account to take them off the books, 124.2, and that's the 75.8, and we're going to allocate it times the 0.375 to M, and that's going to give us the 28,425. And then we'll do the same thing over here. Of course, the difference will be the other, but we'll do the calculation just for the fun of it. 758 times the 0.625. That gives us the 47,375. And of course, the 28,425 plus the 47,375 equals the 75,800. So we're going to allocate the plug, the 75,800, in 28,425 and 47,375, M and L respectively. If we look at the journal entry, then it would look like this. We're going to debit M's capital account 28,425 and debit L's capital account 47,375, and we'll see what the effect on the trial balance will be this time. All right, so here's the same journal entry we have, and this is our chart of accounts, and of course here's that table that we are looking at. Let's see what would happen if we posted this transaction. What would happen to the capital accounts? Does it do what we expect it to do? What do we expect it to do? We expect the ending capital accounts to be M 122,775, B is going to be gone, L is going to be at 217,225 to give us a total capital account or book value of 340. All right, so B's capital account, we're going to debit for the 124.2. So here's B, has a credit. We're doing the opposite thing to it, debiting it, making it go down to 0. Cash is going to go down. So cash has a debit balance. We're doing the opposite thing to it, crediting it. Cash in the partnership will go down to 350. And M has a credit balance in the capital account. We're doing the opposite thing to it, debiting the capital account, making it go down to 122,775. And L has a credit in the capital account, like all capital accounts, and it goes down because we're doing the opposite thing to it, which is a debit to 217,275. So note that the new capital accounts still equal the book value of the company. So the assets of 350,000 minus the liabilities of 10,000 still add up to the M and L's capital accounts at this time. All right, so now we're going to do the same thing. However, this time we're going to have B sells the capital partnership interest to the partnership. However, they're only going to pay 50,000 this time. So same idea, except the exchange will be the 50,000. So is cash affected? Yeah, it's going to go down by the 50,000 in this case. So if we take a look at that, then let's go through the journal entry, see what we can do, where we run into a problem, then do the calculation. So is cash affected? Yeah, it's going down. The partnership's paying B for the partnership interest. Cash has a debit balance. We're going to do the opposite thing to it, which in this case would be a credit. We're going to take B off the books. B has a credit balance in the capital account. We need to make it go down. Therefore, we're going to do the opposite thing to it, which in this case would be a debit. Now the debits do not equal the credits. We need more credits in this case, and the credits are going to go to M and L, the other two partners, and we're going to have to figure out how to break it out between those two partners. Remember, we have our ratios here, so we have M 30, 20, and 50% broken out between a 3-to-5 ratio, and we have our capital account balances represent at 151.2, 124.2, and 264.6, which are represented in the trial balance up here. If we're then going to break out our ratio, then it's going to be looking like this. Same calculation we did last time. If we're saying 3, and the 2 is gone now, so we're dividing by 3 plus 5, so divided by 8. So that's where we come up with the 37.5, and the 5 over divided by 8, which is the 3 plus the 5 because the 2 is gone. That's where we get the 62.5. And so now then, we have our difference of 74.2. So where does the 74.2 come from? B is going off the books at 124.2, and cash is going to be affected by 50. And that's the 74.2. If we multiply that times the 0.375, that's what's going to give us the 27,825, which is going to be allocated to M. And of course, L will receive the difference. Let's do that calculation, however, which is the 74,200 times the 0.625. And that gives us the 46,375. So that's how we're going to break out this 74,200. That's the plug that we need up here. So our new capital account balances then would be the 179.25, which of course is the beginning balance, plus the 27,825, and the 264,600 plus the 46,375, giving us the 310,975, which will give us a total capital account balance of 490. So if we see that in terms of journal entry, we're going to credit or increase the capital account balance for M, 27,825, and we're going to credit L, the 46,375. All right, so if we take a look at the effect of this transaction on the trial balance, then We'll see if it does what we expect it to do. What do we expect it to do? We expect M's capital account balance to end at 179,025, B to be off the books because we have now sold B's partnership and they're not with us anymore. And then L's going to be at a capital account balance of 310,975, giving us a total capital account balance, which is equivalent to the book value of the company, assets minus liabilities, of 490,000. All right, so we're going to debit B's capital account. So here's B again on the books at 427.2. Has a credit balance. We're doing the opposite thing to it to bring B off the books by debiting it, bringing the balance down to 0. So B is off the books. Cash is being paid by the partnership to the partner of B in order to buy B's capital account interest. Therefore, cash is a debit balance. We're making it go down by doing the opposite thing to it, which is a credit, bringing it down from 550 to 500. Then M has a credit here. So here is M, credit balance in the capital accounts like all capital accounts have. And we are going to credit it, making it go up because we're doing the same thing to it, from 151,200 by 27,825 to 179,025. And then L, we're going to credit L. So here's L's capital account balance, has a credit balance in it. We are going to credit it, bringing it up to 310,975. We now have B off the books. We have M and L on the books. And we see that the cash minus, or the assets minus the liabilities, equals the new capital account balances between the only two partners left, being M and L at this time. So we are now able to describe the process of selling a partnership interest, create the journal entries to record the sale of a partnership interest, define the effect of the journal entry to sell a partnership interest on the trial balance accounts, and explain the effect on the capital accounts of selling a partnership interest.